The big one is the individual income tax section. So, making the expiring individual income tax cuts from the 2017 Tax Cut and Jobs Act permanent. So, this is a lot of stuff, a lot of changes with the Tax Cut and Jobs Act. So, one is that the rates and brackets changed. The second thing is that the standard deduction was doubled and exemptions were eliminated. So, the standard deduction is based on your filing status, whether you're single, head of household, married filing joint, married filing separate. Qualified widow or widower is just married filing joint, essentially for a couple extra years. So what happened was under the old system, you had a standard deduction based on your filing status, and then you had an exemption deduction, which was based on the number of people in your tax household, and it was like $4,000. So as a single person, you would have a standard deduction of 6 grand. Then you have an exemption of one person of 4,000, and the total there was 10,000. And basically, under the Tax Cut and Jobs Act, that was replaced by just a flat 10,000. And I'm rounding for all these examples. And then if you were married, then your deduction was larger. And the thing that tweaked people was that the if you were married and had several children, then the new standard deduction was less than the old standard deduction plus exemptions. If you had only father and spouse and maybe one kid, then the new standard deduction was higher than the old standard deduction and the exemptions. So, you know, whether it worked out for you or not depended on how many people were in your tax household. So that was a big adjustment. And back then, the payroll companies did a terrible job of figuring out the math ahead of time. So a lot of people ended up owing in those early years of this law change compared to where they were before because the withholdings were all screwed up. But that's been pretty much ironed out by this point, pretty much. Some people still screw it up. But so that was just one of the big adjustments. Another adjustment was the cap on SALT, state and local taxes. So the standard deduction gets compared against what's called the itemized deductions. Itemized consists of medical expenses above a certain amount compared to your income, local taxes like if you pay income tax in your state, that would be a state and local tax. Or if you live in a state like Florida where there is no state income tax, but you do pay sales taxes, you can pick up the sales taxes that you pay, real estate taxes. So all those state and local taxes under the old system were unlimited. So if you're a high income earner in New York and you pay $60,000 in state taxes, which I have seen, then you would get a $60,000 deduction on your federal income for that tax that you paid to the state. Under the Tax Cut and Jobs Act, that was capped at 10 grand. So the high income earners in those high tax states got absolutely railed. And
Nice.
so that is as unfair as I think that is. Like politically, it was like a masterstroke because all those high tax areas they vote Democrat, and obviously Trump was a Republican, was a primary Republican, and so it was a way to punish Democrat states and reward Republican states. So it was politically was, but obviously a lot of people in those Democrat areas are unhappy about it. And the Democrats have been in a tough position ever since because on the one hand, they have high income supporters in those high tax states that have been agitating to get this $10,000 cap removed so they could go back to the old system where they could take their full deduction on their state and local taxes. But on the other hand, Democrats don't want to be seen to be favoring rich people because that's their messaging. So to date, they have not gotten anything accomplished on that $10,000 cap. Other things that go into itemized deductions are mortgage interest for your personal residence, charitable contributions, and a big factor that was changed in the Tax Cut and Jobs Act was that under the old system, you were able to deduct one was casualty losses. So if your house flooded and you had to do $30,000 worth of repairs, deductible. Under the Tax Cut and Jobs Act, it's only deductible if you are in a federally declared disaster area. So if you were in a fire that was federally declared disaster or a hurricane or whatever, it had major damages associated with that event, that it counted. But if it was an isolated event that was just you're out of luck. Another category that got eliminated under the Tax Cut and Jobs Act for itemized deduction was unreimbursed employee expenses.
Oh yeah, that was the worst.
Yeah. So people who have day jobs where they have expenses, those used to be deductible. And you had to meet
Mhm.
certain thresholds and all this kind of stuff. They had to be above 2% of your AGI or whatever. But they were usable in some way. And then, so we had a lot of people who were in outside sales. So we had one guy who was a liquor distributor for the state of Florida. And he drove the entire state every day. He put 40 or 50,000 miles on his cars, and he would buy a new car every 2 years because of this. And this
Nice.
was all associated with his work and all was perfectly documented and everything. And so that was a huge source of deductions that just got wiped out for the Tax Cut and Jobs Act. Remember, I had another guy who was he wasn't a liquor distributor, but he worked for Cisco, the restaurant supply company. So the first year we were in the Tax Cut and Jobs Act regime, he was sitting across the distributor. He's like, "Hey, you didn't ask me about my work expenses." I was like, "Yeah, that's just not a thing anymore." He was like, "Yeah, I mean, and under the Tax Cut and Jobs Act version, if you have those kinds of work expenses, maybe you're driving around, maybe you are using your personal cell phone, maybe you have a home office for your day job. None of that stuff counts. Whatever that expense is, you either need to go after your boss for reimbursement, or you just have to factor in the fact that is reducing your income. That's just how it is. So if the Tax Cut and Jobs Act becomes permanent, those things are never coming back. Some states still allow for unreimbursed employee expenses, like California, but it's state tax is always going to be a smaller chunk compared to the federal. Other things that are in the Tax Cut Jobs Act on the individual level that are a benefit for people is like the qualified business income deduction. So this is the huge tax break on pass-through income from S corporations, partnerships, things like that, and you can get up to 20% of that income tax-free, depending on the numbers, depending on different different qualifications. Um, if you have if you're a partner in a real estate syndication, let's say, and it makes 100 grand, then maybe, depending on the numbers, etc., you're only paying tax on 80 of it. So that's a huge tax incentive. And if you own your own business, like a lot of our clients do, then it's a big swing. You can optimize your tax load significantly by adjusting the numbers and the payroll and all this kind of stuff to make that deduction as high as possible. We're going to skip the tariff thing for the moment, and then one of the more recent announcements that Trump made, was exempting tips from income taxes. And the Tax Foundation saying here that in 2018, IRS W-2 data indicates 6.1 million taxpayers reported a total of 38.3 billion in taxable tip income for an average of 6,249 per taxpayer. Now, I will let you in on a dirty little secret. A lot of people who work tip jobs don't report all their tips. They're supposed to.
True.
It's such an issue that if for people who are in higher end places, a lot of times their entire actual paycheck is just paying Social Security and Medicare, their payroll taxes, because their tip income is so high compared to their base income that there's not enough money in their base income to cover just the payroll taxes. And so they end up having to kick in more when they file their income taxes. But this is a perennial problem, because when people are tipping cash, then did they report it to their boss to include on their W-2? They're supposed to. We tell them they're supposed to. I don't know if it happens or not, to be honest. But I have seen a number of people get upset when they want to go buy a house that had a tip job, and they say, "Why can't I get a mortgage?" It's like, because you haven't reported any income. The people who give you the money for the mortgage want to see that you can pay them back. That's a conversation I've had many times. But yes, how much of that 38.3 billion is real? No idea. It could be 45 billion, could be 50 billion. I don't know. But 6.1 million taxpayers is a lot of people. And I don't know whether it is it's with Trump, it's hard to say, is that a real proposal or is this just something he's saying, right? So I don't know. But it is an interesting one in that people who make tips are typically younger. So it could just be an interesting demographic to go after for votes. No idea if it'll actually come to pass or not, but it is an interesting idea. As far as like revenue for the US government, 38.3 billion, the tax on that, let's say they're averaging 22%, they're in that bracket. What is 38.3 times 22%? That's $8 billion worth of tax income, which is enough to run the federal government for an hour. So it's just not an issue, but it could be a good politicking kind of thing.